Good day, everyone. This presentation is about portfolio selection utilizing safety-first optimization model on exchange-traded funds in Asia. I am Michael Young from the School of Industrial Engineering and Engineering Management of Puyo University, Philippines. My co-authors are TJ Troy Chwahe and Dr. John Francis Diaz from Chongyan Christian University, College of Business, Taiwan. Here's a short outline of the presentation. First, we have the abstract. Basically, this study presents a portfolio selection procedure that utilizes the safety-first model on exchange-traded funds in Asia with the goal of being an alternative investment that can outperform the China market index. Later on, I'll explain why. Let us proceed to the background of the study. Portfolio selection can be broken down into three parts. We have the return estimation, assignment of weights, and the portfolio selection model. For return estimation, it is where we try to identify what are the investment pool. And from the personal preference of the investors, what are his projected return scenarios. Later on, after having this projected return scenarios, what are the corresponding probabilities based on their perception. After which, having the return scenarios and the corresponding probability, what model would they use to select the optimal portfolio? In return estimation, the projected returns will be based on the investor's individual preference and perception on the market performance. The investor will identify how will he invest: daily, weekly, monthly, yearly. We'll also need to select what will be his investment pool. Will it be securities, stocks, mutual funds, and exchange traded funds? After having the return estimates, we can assign the probability of weights in three ways. First, we can consider equiprobable weights. Second, SPA theory. And third, prospect theory. The basic logic of these three are as follows. For equiprobable weights, considering M historical returns, we can consider the scenario probability as 1 over M. In SPA theory, basically it states that an investor will select an investment based on his fear and hope levels. And lastly, for prospect theory, the logic is that investors are risk averse for gains and risk seeking for losses based on a relative point. After having the return estimates and the corresponding probabilities, we can then proceed in selecting our optimal portfolio. There are two basic ways in selecting a portfolio. First, we have the mean variance model, and then we have the safety first model. For mean variance model, the decision is purely based on the mean and the variance. Variance is considered as the risk of the portfolio. Markowitz states that given two investments with similar returns, a rational investor will always select the investment with the smallest risk. Similarly, given two investments with similar risk, the investor will always select the investment with the highest return. For safety first model, we want to maximize the profit while limiting the probability of losing a certain amount of money at a given probability. Let's move forward to the methodology of the study. From the graph above, we can see that from 2008 to 2018, the cash invested in exchange traded funds or ETFs have increased yearly. With that, we consider the investment pool of exchange traded funds. Looking at Asia, we have collected 9 indexes: Hong Kong, India, Korea, Japan, Indonesia, Singapore, Taiwan, Malaysia, and China. Since from the related literature, we can see that China has the biggest influence on Asian markets. With that, we consider investing on the 8 other Asian ETFs against China. Considering the investment pool of exchange traded funds in Asia, this is our proposed portfolio selection procedure. For the return estimation, we consider historical returns as our scenarios, and then we give them equal probabilities. Later on, we apply the safety first portfolio selection model to obtain our optimal portfolios. In terms of performance evaluation of the resulting portfolios, we compare them through descriptive statistics. Then we compare their performance with the benchmark through pair return difference. And then we identify the portfolio composition and compare them one another also through pair return difference. So this is the results and analysis. Before we proceed to the results and analysis, here are some information about the data and the backtest. We collected data from Yahoo Finance. We collected the indexes of the 9 Asian countries. It is assumed that there is a corresponding exchange traded funds that perfectly tracks these indexes. So the data period is from September 1, 2015 to 2018, and our test period is from December 22, 2017 to August 20, 2018. So the investment scheme is a daily trading strategy, and for the portfolio, we consider 400 historical returns as scenarios for the safety first portfolio selection model. Overall, we have 100 portfolios that covers December 22, 2017 to August 20, 2018. The safety first parameters considered are as follows: negative 5% RL, meaning it is only accepted to have a loss of negative 5%. And an alpha of 2%, meaning you want to limit the probability of losing negative 5% to at most 2%. The portfolios are obtained through the optimization software AIMS. Overall, we have 6 safety first portfolios, and we are denoting it as SF-I, where I is from 1 to 0.2. As I approaches from 1 to 0.2, the more diversified the portfolio becomes. Looking at the performance of all the portfolios, we can see that the safety first portfolios are outperforming the benchmark. The mean return of the SF portfolios are higher compared to the benchmark, wherein all the SF portfolios have positive returns while the benchmark got an average of negative return. In terms of the standard deviation that we can also consider as the is the safety first portfolios have lower values of standard deviation compared to the benchmark. Looking at the composition of the portfolio in terms of positive and negative return, the SF portfolios have higher occurrences of positive return than the benchmark. Looking at the ending cumulative return, all SF portfolios have higher cumulative return after the 100-day test period, while the benchmark loses negative 17.66%. And on average, it is reflected that the safety first portfolios have positive average cumulative return, while the benchmark still has negative average cumulative return. In terms of the composition of these cumulative returns, 99% of the time in portfolio SF-1, we have a positive cumulative return compared to the benchmark, which have only 12 days with positive cumulative return and 88 days of negative cumulative return. Looking at the other SF portfolios, we can see that the number of days with positive cumulative return are also higher compared to the benchmark. Okay, and for a more rigorous test, we perform pair return difference of the SF portfolios with the benchmark, and we can see that SF-1 and SF-0.2 have significantly larger returns than the benchmark. And even the other SF portfolios, the pair t-tests or the p-values are close to being significant. So with that, we can say that the SF portfolios are better than the benchmark, meaning investing on the 8 other exchange traded funds is better than investing on just the China exchange traded funds. So this is a clearer picture of the performance of the portfolios in terms of cumulative return. You can see that all the SF portfolios are above the performance of the benchmark. Okay, the benchmark accumulated a loss of 17.66%, while the profit of the SF portfolios ranges from negative 0.55% to 7.5%. Looking at the composition of the SF portfolios, the safety first portfolios behave as expected. So initially, we expected that SF 0.2 will be a more diversified portfolio compared to the SF-1 portfolio. SF-1 portfolio only invested on 3 indexes. SF-0.8 considered 1, 2, 3, 4, and 5. SF-0.6 considered also 5 indexes, and SF-0.4 also invested on 5 indexes, while for SF0.2 invested on 1, 2, 3, 4, 5, 6, 7 indexes. We then compare the performance of the SF portfolios with one another through the pair return difference t-test. From the results, it can be said that there's no significant difference between the returns of the SF portfolios with one another. It's time for the conclusion. This study contributed in 3 ways. First is the consideration of exchange-traded funds as the investment pool, and the application of safety first model on this investment pool resulted to superior portfolio, meaning we can consider this as an alternative investment. And the actual process or of the investment procedure is a variation of the basic portfolio selection framework. There are still some future studies that can be produced based from this work. Future work can focus on the 3 parts of the basic framework of portfolio selection. For return estimation, they can consider other investment pool, or they can generate return scenarios. Then, these scenarios can be given different weights based on the SPA theory, cumulative prospect theory, and so on. They can also tweak the basic portfolio selection model like mean variance and safety first to develop their own new portfolio selection models. Here are some of the works cited in this study. The most important citation are the 3 on the left, wherein the basic portfolio selection framework are discussed, and from there we expounded our research. Thank you for your time. This study was supported by Mapua University, and I am Michael N. Young. And if you have questions, please contact me through my email mnyoung@mapua.edu.ph.